Core U.S. inflation unexpectedly accelerated in December, reinforcing the outlook for the Fed to raise rates several times this year. That data pushed the yield on the two-year Treasury over 2% for the first time since the financial crisis. How significant is that 2% threshold for the two-year?
Well, I think for those of us who look forward to our retirement years, that's pretty important. But I think that, getting a two-handle on the two-year when you still have a two-handle on the 10-year is getting pretty significant. We actually don't think that the flattening of the yield curve is telling us all that much because we think the long end of the curve is actually being depressed by yield levels around the world. If you look at the real Fed funds rate, it's actually zero. So that would tell you that monetary policy is still very accommodative. So, we have two key measures to look at. The yield curve is the one we think is less reliable now, but nonetheless, I think we're going to continue to hear concerns raised about this flattening of the yield curve, and the two-handle on the two-year is a significant development in that context.
Do you think that, we've seen a little bit more movement on the 10-year to sort of start to more keep pace. Do you think we see more of that, or was that sort of a head fake?
I think in the short run, we hit amazingly right to the tick the lows in late 2014. I think the 10-year futures contract is about 122 plus. We hit exactly there earlier this week. So we may get a little bounce off of that. But we think we're actually headed toward 350 by the end of the year on the 10-year. And that's going to reflect the realization that the Fed does go, my colleague Steve Stanley thinks 4 times this year. And importantly, some of the competition from international yields begins to dissipate, and we see the first step in that regard from the announcement of the ECB when they say it was a pretty mild comment, but their commitment to maintaining QE until inflation reaches 2% may get reviewed. I didn't think they were going to do that anyway. I think they're going to end their asset purchase program at the end of September, but it certainly is highlighting, I think, to investors around the world that one by one, central banks are going to be pulling out of these markets. They're going to be less supportive of long-term debt. And at the same time in the U.S., the Fed becomes a pretty significant seller, effectively net seller of debt during the second half of the year. So you add that to the current deficits, we think the financing requirement in the U.S. could be $1 trillion this year. So you start adding all those things together, and you end up with, we think, some significant upward pressure and actually some steepening of the curve as the year goes on.